Chairman of SBI Johnson right now to talk about all of that. Good having you, Ms. Bhattacharya. Thanks so much for joining in. Let me first start off with your take on the RBI monetary policy, because I believe you were one of the bankers who had requested for a CRR cut. Are you disappointed with the status quo?
The monetary policy is very much on expected lines. I had requested for CRR. I had not said that the RBI would do so. But we felt that this would be one way in which we may be able to get a little better handle on the cost of funds, and therefore that request had been made. But the RBI has very clearly said that they see they don't see any problem on the liquidity situation, and in fact they see quite a bit of liquidity on account of the sterilization that they are doing of the dollar inflow. And they also believe that the government will start its spending cycle because this is the beginning of the year. The government has also got quite a bit of funds on account of the telecom and the coal auctions, and therefore there would be quite a bit of liquidity coming into the market, and therefore they didn't feel this is the right time for the CRR cut.
Right. Ms. Bhattacharya, the CPI is at 5.8% by the end of the fiscal. Does this mean that we can expect a max another 25 bips rate cut? What are your future expectations from the RBI?
Well, if 5.8% actually comes to pass, then they may front load a cut, because we do not know how things will pan out in the future. Also, one has to remember that there is a Fed rate hike that is looming in the background, which of course may not happen this year. Today means today and yesterday, I think there were media reports to say that the Fed rate hike may not actually happen during 2015 calendar year. But I think, it's difficult at this point of time to predict. It would obviously depend on numbers as they come out, and therefore to predict what the June numbers would be or whether the RBI will come out with another 25 basis points, very difficult to really predict at this stage.
Now to the news at hand, Ms. Bhattacharya, you have cut your base rates by 15 bips. What does this mean for your margins?
Well, we'll have to see how we can protect the margins. As you know, over the period of time we had cut deposit rates. So that has resulted in some amount of savings. And going forward, we also have hope that this will kick up or give a fillip to loan growth. So overall, volume growths will be one way in which we will try to protect the numbers. And of course, having said that, we'll also have to see how best we can bring in better efficiencies so as to protect those margins.
Right. Ms. Bhattacharya, so what will be the impact of the base rate cut on your asset side, be it on retail loans or corporate loans? And how will your asset base get repriced then?
Repricing over a year would be in the range of 1,200-1,300 crores, I think, over a period of a year.
Right. So the RBI has stated that they would be encouraging banks to move to marginal cost of funding. What's your view, and what will this mean for bankers?
See, marginal cost of funding at this point of time is a very difficult concept to adopt immediately, on account of the fact that your deposit rates are priced at historical cost. And therefore, if you are not able to also have a base rate on the deposit side, that is a floating rate deposit product, it would be very difficult to do it only on the asset side, because whereas you are only repricing the deposits going forward, you are repricing the entire asset book, and therefore to do it on the marginal costing would be very tough, especially for banks in India where they have, or rather their liability side comprises mainly of deposits, and it doesn't comprise so much of market borrowings or short-term borrowings. If it comprises much more of market and short-term borrowings, then doing it on the marginal costing is definitely something that people can think about.
RBI rationale of marginal cost of funding is that it will enable monetary policy transmission. Now, do you think it will help in the same?
No, again, as I said, monetary transmission happens when you have a lot of market borrowings. If you don't have market borrowings and if you are based on deposits, then monetary transmission in any case is difficult to do. And that is why, what is said is that if you have a lot of credit demand and you are borrowing in the market, you are not able to raise that kind of deposits, then yes, again, the monetary transmission happens faster. But if this is not the case, whatever is your credit demand, you are able to meet it out of deposits itself. monetary transmission will be a difficulty because the repo rate only affects your short-term borrowings from the market. It doesn't affect anything else, and therefore the transmission becomes more difficult.
Many of the corporates we hear are moving to the other sources of funding like CPs, bond issuances, etc. In fact, we've had some of them come and say on record that that's the preferred route as well. What's your assessment of credit demand and growth? And along with credit growth being low, do you believe the banking system will be forced to cut rates due to competition?
Well, competition is of course one of the considerations that we have. The fact that we have actually lowered base rate is based on the fact that we would like to have higher credit growth, and we need to slowly come to a place where we will be able to meet the requirements of the corporates. But as you can understand, because on the other side we have fixed rate products, that is the deposits, so we have to balance the two and ensure that we are able to maintain the profitability that we would like to see.
Deposit growth has slowed down, Ms. Bhattacharya. What's the view on the system deposit growth and demand for retail deposits, and how is that shaping up?
Retail deposits are doing actually quite well. We haven't seen that much of a fall in retail deposits. But overall, whenever the capital markets, etc., do well, there is a lot of bank deposits that goes into such markets. Whereas, if the capital markets are not doing well enough, people park their cash in the banks. So to that extent, there is some amount of money that is going from the bank deposits into the capital markets.
Yeah, I was hearing you at the bankers conference. You mentioned that bankers have expressed some concerns on LCR. Take us through that. And do you see RBI relaxing the norms on LCR?
I don't really know what RBI is going to do. I think you should ask RBI that. But in respect of the LCR, what we wanted to say was that we should not be judged at par with countries that don't have the kind of CRR and SLR requirements that we have. We already have CRR and SLR, and all of SLR is actually high quality liquid assets, HQLA as it's said, and therefore either we should be allowed to take the entire amount of SLR into HQLA, or otherwise the LCR, that is the liquidity coverage ratio, that should be reconsidered. We also have on the liability side deposits which are quite stable. What happens is, in a bank which works mainly on market related borrowings, in the case of a crisis, the markets freeze up, liquidity freezes up, and we have seen this happening in the West during the 2007-8 crisis, when all the lines, the interbank lines, they all froze up. But in respect of our bank or the banks in India which are deposit oriented, these banks, the liquidity position is much better because our liquidity risk is dispersed across a large number of people, and people will simply not draw out their money because at the end of the day they have to keep it somewhere. So to that extent, our requirements of keeping very high levels of liquid assets is much lower. I think this is the point that we have tried to make to the regulator, and they'll surely have a look at it.
Bankers, Ms. Bhattacharya, have been allowed to invest in other banks' infrastructure bonds. What's your view, and how positive is this for the banks and overall for the infrastructure sector?
Well, it's positive for the banks. It ensures more players in the market. This is a new product, so obviously it needs more players. It needs to sort of take root. And for infra projects, it should be a good source of long-term funds.
How concerned are you on the unhedged forex exposure of corporate, Ms. Bhattacharya? And have you as a banker adequately provided for the same?
Yes, we are adequately provided. But at this point of time, we take the numbers as per the declarations given by the corporates. So we don't have any specific concern on that front.
Okay, Ms. Bhattacharya, we'll leave it at that. Thanks so much for joining in today and giving us that perspective. Really good having you.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.